Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Had a very exciting week. We've been talking about it for so long on this podcast, and finally 10-year Bund yields hit positive. So I'm going straight to you, Giles. We've got to zero. Well, actually, I should caveat that. We got to zero today. We're recording on Wednesday. And at the time of recording, they have dipped a little bit under zero again. But we temporarily got back to positive yields, which was very exciting. So where next? Where's the next direction of travel? Upwards or downwards in yield, Giles?
Well, very clearly upwards, I think. I should remind everyone, lest they haven't heard about it, we have this target of half a percentage point for the 10-year point in Bunds this year, and I think that this is, obviously you don't get there, but without crossing the negative to positive, and so that is today's news, and obviously very welcome. I'd stress that it's a little bit actually ahead of the forecast profile that we previously had in mind, but regular listeners, assuming we have any, of course, I'd love to think that we do, will know that that wasn't too much of a surprise. And in fact, rather imprudently last week, I suggested that perhaps you might even, listening at the weekend, have seen this happen already. So yeah, higher. And why? For all the reasons that we've been repeating. I think higher inflation demands a response. Central banks turning more hawkish. The end of QE. In Europe, there's all these questions about cross-border flows and so on. The basic question being, those who were sellers want to allow the ECB to buy what it needed to buy. That took place last year at a certain level, and now they don't need to sell anything like the same kind of size this year. The difference is hundreds of billions, and we don't think that comes without a concession. And so you've got the fundamentals, you've got the flows, everything, and I think maybe the last thing to say about this, what else have we learned on the flows side this week? Well, it turns out that we didn't sell off as much perhaps in the first couple of weeks this year, in part because the ECB was being perhaps more aggressive than we had thought that they might have been, and so we learned that yesterday. And previously you would go, oh, the ECB is being more aggressive, but they can continue to be more aggressive in the future, and therefore I'm going to take that as a bullish signal. Well, now we know that they are coming to the end, or that they're in the process of winding down. It's going to be a long process, and therefore them temporarily, because we now know that it is temporary, being more aggressive shouldn't necessarily be seen as a bullish signal. On the contrary, to the extent it was supporting the markets, the bearish.
I was going to say to what you said before, I'm sure my mum would class herself as a regular listener, but hopefully we have some that also know what bunds and yields are as well. But yeah, I think that's a really good point that you make as well about the ECB flows, because I think that went a little bit under the radar yesterday of how strong those flows actually were. And also the data covers the week of Epiphany Day last week or the week before. And so actually that was a kind of low liquidity day too. So perhaps it's even stronger than it might have otherwise looked. So I guess the other big story in Europe this week, like bringing it a little bit back to the front end, has been how many hikes really the front end now has priced in. We've got one full hike at least by the end of 2022. That's one 10 basis point hike. And then we get back to 0% by the end of 2023. So an additional 4 at least in 2023. The ECB have been very clear so far that they don't think rates will rise in 2022. And I think you'd be hard pressed to get them hiking as fast as the market is pricing in. So is this the market that's saying that they think the ECB is going to be more hawkish than they're saying, and they are going to have to hike faster? Or is that front end pricing a reflection of something else, perhaps related to TLTROs or anything else?
Excellent question. Yeah, I mean, listen, I think it's perfectly legitimate. Oh, I don't just think, it is clearly perfectly legitimate for the markets to say, okay, well, we understand your assessment. Nonetheless, we think that there's a reasonable chance, at the very least, that you are being too sanguine, as you were for most of last year about inflation, and that by the time you are taking stock around the middle of this year, you're going to be in more of a hurry. So that's the first thing to say. I don't think that's crazy, but I think that to price in a full 10 basis point rise by September is pretty aggressive. And the rest of the path that you are describing, Imogen, into next year is also already pretty aggressive. In fact, I'd say very aggressive. Now, I mean, to answer the question about, is there a liquidity component in there? So this idea that because we have this exceptionally easy sort of monetary policy with loads and loads of liquidity that kind of sloshing around, that's kind of driven market rates down even further, sort of below the policy rate. If we have liquidity events that kind of take away some of that excess liquidity in the coming months, and the TLTRO is potentially a big one in June, I think it's perfectly reasonable to be talking about $500 billion, $1 trillion, something like that. I mean, very large numbers of repayments. Then does that change things, and should that be priced in? And so maybe the front end is actually considering that risk rather than an actual conscious decision by the ECB to raise its policy rate. And the answer is no, that's not what's going on. Okay, I mean, if anyone is sort of, if that is the part of the rationalization, it doesn't mean that you shouldn't oppose it with rate hike arguments. Okay, I don't think it makes sense for the front end to be pricing rate hikes quite this aggressively. And bottom line, yeah, I think that there's value in the front end.
Okay, thank you. Now, final question on Europe, because we spoke about this a couple of weeks ago, and I promised listeners that we would talk about it again when the time came. But by the time this episode is out, or by the time listeners might be listening to this, we'll be thinking very much about the Italian presidential elections. Voting starts on Monday, and we think could well take a few days before we get any kind of conclusion. But how nervous are you about this as a kind of risk event for BTPs?
Well, listen, I mean, there are a number of risk events out there, to be honest with you. The presidential election in Italy is one of them. I mean, politics and geopolitics are, I mean, they're very much, I'd say that they are up there with inflation as potential drivers for this year. This week, obviously, I also have in mind what's going on in Russia, for example. And we shouldn't take our eyes off the ball with that by any means. And I only say so because we haven't discussed it in any other context on this call. But it is super important for the Italian election. Well, I guess that our line on this one hasn't particularly changed. We in fact, you went through the scenarios in something that we did last week, and the sort of probability weighted assessment of the various outcomes actually supported a more constructive outlook on BTPs. Now I think that around about where they are is probably balancing risks reasonably well, but I think that it makes sense for investors to be cautious because the range of outcomes and is pretty wide. So I think there could be absolutely some volatility next week. I don't have a lot else to add. I mean, it's a sort of private closed ballot. We don't really know who might be genuine. I mean, even sort of behind the scenes, sort of trying to get support and so on. These things are hugely unpredictable. The bottom line is markets want to see Mario Draghi continuing as prime minister and don't really want that to change. So, and it may well. The other point, maybe just to finish on this, though, we were also looking at the flows around BTPs, particularly thinking about banks and thinking about behavior around the beginning of the year. And actually, that didn't look particularly, in fact, we came away from that exercise feeling a little bit reassured. Let's just put it there.
A nice plug for any of our listeners that have access to my Agile Markets. Watch out for a note coming on that very soon.
Or maybe we can talk about it next week, Imogen.
All right, next week's discussion. I'm sure people will be very interested in that. So we've not got Theo with us today, but on a day when a kind of another overshoot in UK inflation has really been driving rates markets, it feels a bit remiss to not mention it on this podcast. So perhaps you can step into Theo's shoes a little bit today, Giles, and just give, I guess, your updated thoughts on UK inflation following that big upside surprise this morning, which has led to a fair amount of repricing at a moment when it felt like we might have been coming close to kind of peak hawkishness at this moment in sort of global fixed income markets.
Well, I mean, yeah, listen, it just shows yet again how uncertain inflation is at the moment everywhere, and particularly in the UK. It was a very big upside surprise, and I think it clearly, we also had labour market data this week in the UK, and together I think it almost certainly nails on the rate hike that markets have been expecting for a while in 2 weeks' time at the February meeting. I think, if anything, it's probably not ridiculous to be starting to price in some risk, at the very least, of possibly more than just the 25 basis points that are currently priced in there. But certainly, I think it ups the ante for rate hike expectations in the UK over the course of this year. So maybe that's enough on that. But it's fueling inflationary sentiment everywhere today, I would say.
It definitely is. All right, then, Dan, over to you in the US, because until today, when I said, like I said, the UK has been driving markets. It's really been US Treasuries that have been driving global fixed income markets higher. And by that, I mean really yesterday, because they were, of course, out on Monday. But yesterday, they moved higher in quite a big way. And so what was driving that shift, would you say?
Yeah, but I mean, Giles will be a difficult act to follow with his really broad coverage today. But a quick look at Treasuries. Last week, when we were kind of writing our closing remarks for the week, we saw two different paths that trading until the next week's Fed meeting can go. I remember now we're in the middle of a self-imposed blackout period by the FOMC, so they're not going to be any FOMC officials speaking until the meeting. So we saw really two alternatives, and that's what really would have made these 2 weeks interesting. First would be what we have been seeing. In fact, there was a lot of powerful hawkish rhetoric built into the market. I mean, even after we recorded the podcast last week, where we sort of touched up on this, but it wasn't really as pronounced. And the last few days, even last few hours of the week, there was just like a slew of FOMC officials coming out and in a very harmonious tone saying, we're not going to tolerate inflation, or we're not going to tolerate inflation running its course on its own. We're going to have to act. There's not going to be a lot of waiting around. And that came from, you would expect that from the more hawkish side of the aisle, but the other end of the spectrum also gave that, was behind that idea. So I think that was scenario A, where markets could run with that rhetoric and start building new ones on top of it. So what I thought could happen, what we're seeing now is things like market pricing at 50 basis points for March. I think that's wrong. I think that has nothing to do with our core views of rates going higher, driven by the front end and the belly. But for the March meeting, I think that's a little bit excessive. They're still in quantitative easing. We still haven't exited bond buying. We are about to, but I think we're getting a little bit ahead of ourselves there. And B, I think it's just not that consistent with the Fed's way of signaling things. And I don't think they would want to give that position of being in panic, if that makes sense. But I think that's what's happening here. What we're seeing, well, today it has reversed a little bit, but what we're seeing is just markets really running with the view that the Fed's going to have to be really quick, really big, and really aggressive.
I guess along those lines then, what's your view for what they deliver, if anything, at next week's meeting?
Next week's meeting is probably going to be pretty critical in setting expectations for the remainder of this year. We don't expect anything specific on, as an action. They probably are going to allude to a potential rate hike at the next meeting. Well, we're envisioning something like 2015, where they said they're going to determine whether it be appropriate to raise interest rates at the next meeting if economic conditions hold and if it's consistent with their dual mandate. So we think we can get some language like that. Additionally, which would solidify a March hike. We also think that they're going to mention how they have been discussing balance sheet rundown again. This will be the second meeting, as the December one was officially the first one where they debated it, as we saw in the minutes. So that makes the second one and opens up room for mid-year beginning to balance sheet rundown. And I just think in general, the language behind in the press conference is going to be a lot more echoing what we got from the other officials coming out and saying the Fed's not going to be waiting around this year, and they're going to be reducing the balance sheet, they're going to be hiking interest rates, and they're going to be trying to tackle inflation now and completely abandon the transitory rhetoric.
So one final question, I suppose, is that we and regular listeners to the podcast will know that we've been calling for some time for higher rates in the US and a kind of flatter curve, such that the sell-off is really led by the kind of 5-year and the belly of the curve as more rate hikes are priced in. And that's been a very good call for, we've had it on almost a year, perhaps now maybe a bit less than a year. But what do we think then is the trigger to get to that point? Because like you say, we were thinking kind of last week, we got to maybe sort of peak hawkishness, and then we had this second round of hawkish kind of comments at the end of the last week and over the weekend, and now we're in blackout period. So what does it take for the market to really get to the kind of terminal rate that we're thinking about of 2.5% or higher versus what they're expecting right now, which, correct me if I'm wrong, is probably less than 2%, I think?
Yeah, so the market flatlines around 6.5, 7 hikes. There's 6.5 more or less priced in by the end of 2023, and up like a couple of years after that, it just flatlines around 7. So the market right now views that this will be a quick and fast cycle, but it's not going to be a prolonged cycle. That's where we really differ. We think this economic kind of cycle has more legs to it. I think it's going to, we think it's going to run a little bit longer than what's priced in by the OIS markets. So our expectation is that once the Fed starts hiking, they're not going to stop abruptly. And next year, we think they're going to keep going until they hit something like the 2.5%, they're longer on target, or perhaps with risks for upside for that. We are a lot more optimistic, I suppose, on this cycle and on the longevity of this cycle than what's priced in the market. So we think that's going to be the next catalyst, just accepting that even these, once the Fed starts delivering these hikes, it's not going to be the end of the growth boom that we have been seeing and we're likely to continue seeing for some time. It's not going to be the end of that. And once markets kind of fully price that in, that should lift that the flatness of the very front end and assume that the Fed can continue a little bit down the line, boosting 2s and 5s and such.
There's still more hawkishness to come despite all the repricing that we've had so far. All right then, thank you very much, both of you. I think that's probably all we've got time for, but we will catch up again next week after the Fed, and we'll be able to assess everything that we've been talking about, and of course, well, potentially after the results of the presidential election in Italy as well. So yeah, thank you again for joining me, and just a reminder to listeners, if you liked today's episode, don't forget to hit the subscribe button so you can get the latest episodes as soon as they're available. See you again next week.